Good morning. It's Tuesday, the 27th of January. Here's what's on the agenda. Stocks show tariff threat resilience. Precious metals march higher. And will a Trump ICE strategy shift reduce shutdown risk?
The equity markets modestly on the front foot this morning and are looking to build on the gains that came through yesterday. European stocks ended high by about 0.2 today, looking to add to that, pointing up by 0.3%. Futures in the US looking to add 19 points, pointing high by 0.3%. Again, looking through the trade tensions of the morning, and gold, the debasement trade continuing. Again, gold and silver rallying very strongly in the session. Again, up 1.5% on the yellow metal. The countdown to the opening trade starts right now.
Good morning. How are you doing? Another Trump tariff threat, another post-Greenland shrug of the shoulders from the markets. That is what we are looking at this morning. It is Taco Tuesday, but it seems that every day is a taco day these days. Yesterday it was Canada. Today it is Korea. What comes next? We wait and see. It's going to be interesting to see exactly how the UK deals with the Trump-China trade later on this week. But we'll watch that one. Maybe the EU is going to be in the firing line this morning for the India deal. I don't know. But there's some fantastic Bloomberg economics analysis out there this morning that says that Trump only follows through on 20% of his tariff threats every day. It's Taco Day.
Yeah, it seems they just don't stick. And markets, are they fully discounting this tariff today? I guess you don't know where the Kospi would be without the tariff, but it's certainly doing very well today. Yesterday, the Kosdaq up really strongly, those mid-cap stocks over in South Korea. South Korea generally having an incredible start to 2026, and the Kospi is still flying this morning, despite this trade tariff threat, up by 2.7%.
Yeah, and for the details, this is about essentially the Trump administration putting pressure on the Parliament of South Korea to actually implement this trade deal that they came to, and he's threatening tariffs that would hit farmers, pharmaceutical products, autos, of course, so the likes of Hyundai, of course, in focus on that front. But to your point, it is the AI trade in South Korea that is showing the resilience once again. Inferencing AI chip, but it's also a reminder, to your point, Guy, that we may get more volatility in terms of the trade deals, because when they're written on the back of an envelope over 12 months, implementing them becomes difficult.
Yes.
And so we should probably brace for further pressure campaigns from the Trump administration that has sealed deals, but without always the detail. And we see that in terms of the UK-US trade deal as well.
What happens the rest of this week? Like you've got a deal being done today with India, with the EU. Is Trump going to be annoyed with that because Trump's struggling with India at the moment? Is he going to be annoyed that Brussels has done a deal there? Starmer says, we'll talk about this in a minute, but Starmer says he doesn't have to choose between the two. Is Trump going to see it that way?
They're both India and the EU with this trade deal on the table then to be signed today. They're both incentivised, aren't they, to try and find other trading partners other than the United States. The EU very bruised after last week, and India still facing really punishing tariffs.
So is the India-EU deal a Sell America deal? Is it the same trade that the market's basically putting on at the moment, which is the diversification trade? You want to look for other trading partners, you want to look for other options. China's certainly doing that aggressively at the moment.
They've talked for 20 years, haven't they, about this? But maybe it's no coincidence that this got them over the line and got them to the point of being able to sign it.
We have a terminal chart on the debasement trade that shows the upside coming through, that has come through for gold and silver versus the US dollar, and you were zeroing in on dollar weakness yesterday. The dollar has stabilised a bit in the session today, but the options trading suggests that traders are still very bearish on the greenback. And when you get threats of additional tariffs on South Korea, threats of additional tariffs on Canada that we got through over the weekend, of course, all of that coming together to accelerate this move further into the precious metals. And that doesn't seem to be abating. We heard from Amundi strategists earlier today saying they see further upside, well above 5,000 for gold. Interestingly, you know what's not performing in the debasement trade? Bitcoin. It's down about 12-13% year to date.
Yes, it's really interesting, isn't it, the difference between gold and silver as well. Silver proving to be incredibly volatile. Some on the Markets Live blog asking as a result whether we are reaching the top on silver. But gold seems to have different narratives and different backers. Certainly, you mentioned the Amundi story. Looking at silver, the Markets Live team saying we've seen 7 moves of more than 2 standard deviations in January for silver. In all of 2025, we only saw 10. So the volatility around silver, and we saw it up. At one point yesterday, it was up by 14% in the US session, silver. And then it closed almost flat relative to where it started.
Big reversal.
Today. So incredible reversals that we're seeing intraday.
There's another fantastic chart that's floating around. It comes out of the John Author's piece, and it's the S&P in gold. And it basically shows you, if you put the S&P in gold, that the US equity market has made no gains since the GFC. So if you want to see a visual representation of the debasement trade, that is it. The S&P, you have done nothing if you put it into gold. So choosing your currency in terms of the way you think about where you're going to go with these equity stories is really important. And you can just see it on the screen every day. Put the S&P in euros, put the S&P in pounds, put the S&P in yen. Change the narrative and the way you look at it, and the debasement trade becomes clear very, very fast.
Yes, it does. I'm not sure about the day where I get to take the gold bar to spend it somewhere, though. So you've got to turn it into something, haven't you?
But gold is.
But if you're just going to hold the value,
gold is divisible. It is fungible. It ticks all the boxes when it comes to money.
OK, let's talk about what's going on in the United States, because this is interesting. President Trump seemingly trying to change the conversation a little bit when it comes to what's been going on there, or at least trying to find, in his words, finding common ground, agreeing on some things with the Minnesota governor. And the reason this matters, it matters to America hugely, but it matters to markets because of the shutdown narrative and whether we get closer to a shutdown. Their polymarket betting is suggesting that we got a lot closer to a shutdown over the last couple of days. And this is just at the end of this week. This is not a distant prospect. This is the end of this week. But the politics has not really changed. The Democrats still asking to separate out the Department of Homeland Security funding, and the Republicans saying they won't do that. We will see whether this slight pivot in the language does anything to that. You don't think so?
This could come to a head. This could come to a head over.
No. I was thinking about something else.
I think it's a reminder that you can make the argument that the US has an image problem on the international stage and domestically as well. It doesn't look good when you are killing peaceful protesters, when you are arresting them and roughing them up on the streets of Minneapolis. It is not a good look for the United States. That's feeding into changes around the domestic politics in terms of the moderates on the Democrats who voted through past spending bills, to the chagrin of someone and some others on the left of the Democratic Party. They are shifting now. Even Republicans are feeling uncomfortable. So that is why you've seen this shift in strategy. To your point from President Trump, he realises this could come to a head, and this is not polling well for the president either in the lead up to the midterms.
Let's just bring it back to the markets and talk about kind of what impact a government shutdown would have. BLS data gone again. That's another huge factor. So we end up in a data drought once again. We don't understand what's happening with the labour market. We can't figure out that story. Crucial to the Fed decisions that are going to be coming up. Does Trump change his path when it comes to the Fed? If he's got a more hostile Congress, does he decide actually he needs somebody that's going to be easier to get through Congress? Does that change the arithmetic around Rick Reader? Does it point to Waller? Is Waller believable when it comes to the dovish narrative? So you've got to kind of... Does it change all of these narratives when you think about how we are going to be pricing in some of the rate decisions that are coming up? Fed decision obviously coming up very, very shortly, tomorrow. So all of this is going to feed back in to the market narrative. We've just been through a data drought. Are we about to get another one? Does it change the Fed story?
And just in case you were wondering, I saw confirmation that the FOMC will meet, despite the snow, despite the fact that there are various federal closures around DC. That meeting is still going to take place. So there you go, some things we can rely on, it would seem. Let's tell you what's coming up on the programme. Guest conversations. Dominic Bunning will be with us from Nomura, G10 FX strategy head. We're still thinking about the yen, of course, but we're also increasingly thinking about the dollar, stabilised today, but the dollar weakness very much still a thread that we need to pick up on. Isabel Matias-Ilago, BNP Paribas chief economist. What difference do trade deals such as the size and scope of the India trade deal make to a European economy? What else is driving things on the ground? Richard Saldana will be with us. Aviva Investors, Globally Equity Income. We'll talk about resilience to tariffs, perhaps. And Jonathan Schur, who's investment strategist at UniCredit for energy and sustainability. What leverage does the Trump administration have when it comes to energy policy around LNG exports into Europe?
Here's what else to think about today, then, on top of the guests and, of course, the conversations coming up on this show. We've been talking about the fact that SK Hynix is waving the flag in terms of AI again in the session today. Well, NVIDIA's Jensen Huang will be in China. In terms of price to earnings, by the way, you're looking at SK Hynix trades on price to earnings of about 15 versus NVIDIA's 47, despite a run-up of 300% in the last 12 months for SK Hynix. Anyway, the EU-India summit is taking place in New Delhi. We touched on that. Aftermarket, LVMH, Logitech earnings as well, so a touch on luxury and consumption there, of course, around LVMH. And later, Boeing earnings before market and Texas Instruments as well. Those earnings come after the market.
It's a lot of earnings. We're starting to get
the build-up, isn't it?
Big tech tomorrow. Tomorrow, it's kind
Wednesday.
of... That's really what we're looking forward to, isn't it, here, and what we're going to learn. It feels like a crucial week. Can I ignore the Fed this week? Is a question also. Doesn't feel like the Fed's going to do anything. And can I ignore forward guidance from the Fed? Because as we've just been discussing, there's a new chair coming.
Well, it's interesting that previously we would have thought Jerome Powell's not going to weigh in on all the politics. He downplays it. But then since the last meeting, we had that spectacular video that he recorded. And so now maybe
the press conference is going to be gripping.
Yeah,
he talked about independence and intimidation. I mean, that's going to be pretty.
But yeah, maybe we can ignore the decision.
It's less the decision and more the press conference.
Well, no, it's more. It's less like the decision feels like it's fairly straightforward. Yeah. It feels like they're going to park it for now. But what are they going to signal? And can I ignore the signal? Because we're going to get, well, it may be there, but when we get a new Fed chair coming who's going to change the signal quite aggressively, I don't know. It depends how. If the committee if there's divergence of views on the committee, maybe that will be the useful signal. The Fed chair is coming into the new Fed chair is coming into a more diverse group of thoughts when it comes to the FOMC. Anyway, lots to look forward to tomorrow. What else do you need to know this morning? PUMA shares are seen surging on trade gates. The Chinese sportswear giant Anta Group is buying about a 29% stake in the German brand, making it the company's biggest shareholder. Anta says the $1.8 billion purchase is a key step in the firm's multi-brand and globalization strategy. Bloomberg reported in November that Anta was amongst the companies exploring a potential takeover of PUMA. European car sales grew for a third year in a row in 2025. New vehicle registrations rose 2.4% after another jump in December. A surge in electric vehicle registrations helped drive the numbers as more affordable European and Chinese models hit the market. But the European Automobile Manufacturers Association says sales are still around 15% below pre-pandemic levels due to tariffs and rising competition. And the UK Prime Minister Keir Starmer says he won't choose between the United States and China as he flagged, quote, significant opportunities for British business ahead of his trip this week to Beijing. Starmer told Bloomberg that he can meet President Xi Jinping without angering Trump or harming relations with the United States. Starmer also told us that while the UK will maintain close ties with the United States, it doesn't make sense to ignore business opportunities in China. He thinks he can get away with this. Right. Carney is learning that maybe you can't. But then the markets are shrugging their shoulders and saying Trump always chickens out. So maybe the politicians start to take that view. Yeah, maybe you can have best of both worlds. You do feel like Mark Carney, or the impact that Mark Carney had at Davos and the result of his trip to China is sort of on the shoulder of Keir Starmer as he goes to China this time around. He's certainly going to be asked about it a lot, whether he's of the same view as Mark Carney, and actually he's really distancing himself a little bit from what
that was interesting,
wasn't
it? In the interview with Alex Wickham, Bloomberg's interview with the Prime Minister, saying we're not following the Carney doctrine on this. We think we can have very close relationships with the US, while also striking some form of trade deal with countries like China. He's going with 60 executives to China. You have to wonder what the upside is in terms of material access to that market, though, for UK executives and businesses, given that longer term China is ultimately trying to shift fully to kind of domestic build out of its own companies. But we'll see if there's any dividend, really, for the Prime Minister.
Coming up on the programme, Burberry gets an upgrade at Barclays after it recently reported a sales jump in China. We will check in on the stock at the open. Plus, Roche shares are likely to be on the move after positive results from the obesity drug test. Up next, we get back to the dollar. We talk about that and have a conversation about gold, of course. All of that in focus. Dominic Bunning will be with us. If you have any questions, want to get involved in these conversations, IB Plus BBTV Go is the function to use. This is Bloomberg.
I think the economic setup is pretty constructive, especially in the U.S. But broadly, I think it's relatively constructive. You've got a confluence of lots of stimulative fiscal policy in developed economies. You have a general deregulatory trend and tone, both in the U.S. and Europe.
That was Goldman Sachs CEO, of course, David Solomon, speaking to Bloomberg, talking there about the US economy. Let's keep that in focus and speak to Dominic Bunning, head of G10 FX strategy over at Nomura, and he joins us now on set this morning in London. Very nice to have you with us, Dominic. So we heard there from Goldman Sachs talking about the US economy and the resilience. That story does not seem to be in the driving seat when it comes to the dollar right now. Other things are. What does the conversation around the dollar look like now? There's a lot of talk about debasement, etc. But what does it look like when you talk to clients?
Well, thanks for having me on, for starters. But, I think there's really a big question mark now about the broader policy-making backdrop in the US. So for many, many years, investors have seen the US as a sort of a place where you have faith in the institutions to deliver somewhat coherent policy. Now, it doesn't mean you always agree with the policy, doesn't mean it's perfect, but, when you think about the structures that are in place, when you think about the independence of the Fed, all of these sorts of things, it's an environment where, as an investor, you sort of have some faith in the whole structure. When policy making becomes this volatile, and it's not necessarily all the bad stuff, it's the bad stuff that gets pulled back and the volatility behind it, suddenly I think investors are really starting to question, even more so than last year, do we want to continue to hold the degree of investments we've held in the US? Now, that doesn't mean we're selling everything, but it just means we're going to allocate less and less. And actually, when you look at places where there's a bit more coherence in policy making, where you've got longer histories of low inflation, more stability, those are the places that seem to be benefiting.
OK, so less and less allocation to the US, not selling everything. Is it possible to get a size and scope around what that really means for the dollar? How much negativity that adds up to for the dollar?
Well, it is very hard because, when you can talk about the numbers of, when you look at international investment positions, you're talking in the multiple trillions of dollars. And if that were all to change, then clearly it's going to have big impacts. But again, estimating how big that shift will be is quite tricky. What I do think is notable is that, the dollar from a valuation perspective is still relatively expensive, not as much as it was before, but it's relatively expensive. And the things that were supporting it, for example, much higher real rates than the rest of the world, those have been diminishing. So actually, going back to the economics, there is a link there that, when you've got people talking about a strong US economic story, well, that's fine, but you've got a strong US economic story where rates are being lowered. So actually,
down,
so you're kind of getting, again, a bit of incoherence, less positive real rates, less of a support for the dollar. So, I think this trade does have further to run. I think we could see, 5% and at a stretch maybe a 10% move if things were all to move in a bit more of in that direction.
Can I talk about a group that could be active sellers, and that's the Japanese? There's two stories floating around this morning that really caught my eye, both kind of basically point in the same direction. John Author's piece mentions Robin Brooks, but you've got the kind of SocGen note out. I think it's a SocGen note out this morning talking about it, but you've got others talking about it as well. The GPIF could sell, i.e. the giant Japanese pension fund, which has huge holdings in US treasuries, could sell. And you do wonder, we're now in a situation where it seems that there's tacit approval from America that maybe that would be possible to support the yen. How far has this got legs? Are we about to see the Japanese selling treasuries?
I'm not going to give you a yes or no on that exact answer, Guy, but I think there's definitely a rational theme there, right? So a lot of the time in the last few years, people have seemed to speak about the Japanese bond market, the unwind story, and almost like a quasi-EM story. The big difference is that Japan has this massive asset position overseas, a net international investment positive, right? So is there scope for, whether it's GPIF or actually just some of the lifers, for example, to start to shift their hedging or to shift their asset allocation? There absolutely is. And I think there are a few things that have changed in the last few weeks that really make that plausible. One is, JGB yields being positive in real terms. So a lot of these funds have got real return kind of goals, GPIF 1.9%. So you're starting to get some of that just in carry terms, and you're not taking on the FX risk if you shift. You've also now got this idea with what we've seen, late last week, that maybe dollar yen isn't a one-way upside trade anymore, whether it's because there's been official intervention, which isn't that clear yet, or whether there's been this kind of tacit shift towards pushing back on yen weakness. So those two things are changing meaningfully, and there is scope for those allocations change. Now, they're not going to change overnight. It's going to be a slow burn, but I think it's an important...
Would the US be prepared to tolerate higher yields to get a higher yen?
I don't necessarily think that's going to be the case. I mean, we talk about GPF, so $400 billion worth of holdings, right?
Yeah.
Now, how big is the Treasury market?
Sure.
Even if you sell 10% of those holdings, $40 billion, now, over a long period of time, I don't think that necessarily has a massive impact on the Treasury market itself. It's a marginal change.
Shift.
It's a signal.
Precisely, it's a signal. It changes the tone around US Treasuries, and you start to see Treasuries being marked higher.
It does, but I think the bigger impact is still the bigger impact is still going to be on effectively the smaller market. The size of the flow is going to matter more. Now, I think there's an important signal there for sure, but equally, Do US investors still have appetite for fixed income products? Absolutely, and when you're getting, 4.2 on a 10-year, it's still a relatively attractive yield compared even to where inflation is in the US. So, look, I don't think it's a case that suddenly treasuries need to sell off massively. And actually, interestingly, we had conversations this week with clients. We've had our chief DM economist was over, so had a lot of meetings with him, and actually investors are quite bullish on duration in the US, actually. So that theme isn't sort of playing out whereby there's going to be this massive portfolio shift. Again, it's marginal changes in preference for where additional flow is going to go, I think, and that is more impactful on the slightly smaller market, so the JGB market, than it would be on the Treasury market, in my view.
Are you hearing, then, that there are buyers waiting on the sidelines for Treasuries outside of Japan?
Yeah, look, I think we can talk about the end of US exceptionalism, the end of the dollar as a reserve currency, which is kind of nonsense in many respects. It's a slow burn. There are always going to effectively be buyers of US Treasuries. There absolutely are. We're not going to see this kind of tailspin in US Treasuries. Like I say, I think there is still potential for a big move in, say, the FX market, but it doesn't mean that the Treasury market has to unwind. Those are two sort of different things. They're not necessarily mutually.
How much pushback do you get on your views around the dollar? If we're getting 5% growth in 2026 for the US, if we're getting continued AI leadership in the US, we're getting the fiscal spend, and if we're getting someone who is market friendly heading up the Fed, are you getting pushback with that narrative at all?
We got a lot of pushback in October, November last year, when we were sort of saying that, yes, we can see this path to dollar strength, but it was almost sort of like, look, there's one way in which you get dollar strength, which was everything stays the same. US growth continues sort of relatively unabated. You get these kind of, the AI theme, you get US equities performing. But there are multiple paths to dollar weakness. So you could have something, effectively some kind of upset in the equity market that causes those outflows, some kind of downside surprise to US growth. And we know the Fed's reaction function is more skewed to sort of protecting against employment. Or you could get this hedging story, you could get this upside surprise in the rest of the world. So there were multiple ways in which the dollar could weaken and weaken quickly, whereas there was sort of only really one path to a grinding dollar strength. That was the argument we were making. I think we've been kind of proven somewhat right, and we've been been short dollars basically since the middle of Q4 last year, and it has. And I think really the question we're asking now is much more: has this gone a bit too far, a bit too fast? But we're not getting any pushback now because things have moved.
Dominic, thank you very much indeed. Dominic Bunning, head of G10 FX strategy at Nomura. Let's check in on some of the other Asian markets right now after President Trump's latest tariff threats of 25% levies on goods imported from South Korea. Let's bring in market reaction and Winnie Su standing by. Winnie.
Yeah, morning, Tom. You are really seeing that investors shrugging off these tariff risks pretty quickly. As you can see how the Kospi has done throughout the day, actually dipping about 1% at the open, but quickly taking that U-turn and reversing those losses and actually ended 2.7% higher. So it really goes to show how it is that taco trade and trading for dip buying opportunities. However, not so lucky in terms of the currency space, as you see that the won is still under a bit of pressure, given that Trump's agenda is a lot focusing on the weaker trend of the dollar. Hyundai Motor here also fluctuating a little bit despite the tariffs being focused a lot on the auto sector, pharma sector, and Lombard. When it comes to what's really driving the Korean stocks today, it is SK Hynix up 8% here, and it's coming after a local report saying that the company is the sole provider of the HBM3E, which is the advanced memory chips for Microsoft's Maya chips. Now, also just want to flip the board and take a quick look at the broader Asia market, because in terms of the Japanese yen, still under a bit of pressure. In fact, with investors still watching that intervention risk, but that weakness in the yen actually helped the Nikkei 225 reversing some of the losses yesterday. Back to you, Tom.
Winnie, thank you very much indeed. Coming up, the mother of all deals. That's the words of Commission President, of course, Ursula von der Leyen. As India and the EU agree a trade pact, we have the details next. This is Bloomberg.
Minutes to go until the start of cash equity trading here in Europe. Equities seem to have found a forward gear finally. A couple of negative weeks really around the world for the equity picture. That seems to be getting a little bit better as we start this week. Monday into Tuesday looking a little bit more positive. Euro Stoxx 50 called up by 0.3%. US futures, the Nasdaq's up maybe 0.5%. The S&P maybe up by 0.3%.
Let's talk about what's going on in bond markets then, guys. So that's the picture on futures for equities, looking kind of rosy, at least slightly, slightly rosy. Let me tell you about the bond market story. Yesterday we actually saw some fairly sizable moves in the French bond market, outperforming there with the yield down by 6 basis points at the end. A bit of progress in the budget conversation, it seems, in France. But this morning, opening then pretty flat with just moves of 1 basis point or so. A little bit of selling of European bonds this morning, but nothing to get excited about.
OK, let's get an update on trade. Certainly some of the EU officials getting very excited about the trade deal between India and the EU. Prime Minister Modi saying that India and the European Union have agreed a free trade pact. The EU's Ursula von der Leyen and Antonio Costa are in New Delhi to mark the historic deal. Bloomberg's chief correspondent, Oliver Crook, is in Brussels, joins us now. Ollie, how significant is this really? What are the terms of this deal?
Yeah, I mean, it depends who you ask. If you ask Ursula von der Leyen, it is the mother of all deals, a quote sort of taken out of the Trump book to try to describe what this is. We just got this sort of press release from the EU that actually details what is in some of this deal, and I'll just bring you some of the highlights that the EU is trying to highlight here. What they're saying is that it is the most ambitious trade opening that India has ever granted to a trade partner. India has a notoriously sort of high trade barriers historically, that obviously now changing in the favor of the European Union, says Ursula von der Leyen. Tariffs on cars are gradually going to go down from about 110% to as low as 10%. They will be also fully abolished for car parts over the next 5 to 10 years. Tariffs ranging from 44% on machinery, 22% on chemicals, 11% on pharmaceuticals will also be mostly eliminated. There is something also in here for the farmers, we should say. This is obviously a point of high concern for European farmers. What it will do is it will remove or reduce prohibitive tariffs on EU exports of agri-food products, opening a massive market to European farmers, says the EU. And Indian tariffs on wines, for example, will be cut from 150% to 75%. We have olive oil, something for the Italians there, down from 45% to 0% over 5 years. But also, this is the key side of this, because of all of the protests we've seen from farmers in France, in Belgium, in Germany, all over the place. The protections. There's going to be protections for sensitive European agricultural sectors will be fully protected, such as beef, chicken, rice, sugar are excluded from this agreement, and all Indian imports will continue to have to respect the EU's strict health and food and safety rules. In terms of the actual impact economically, we did have Allianz come out in terms of what the impact would be for the European Union. They say it could boost exports to India by about $19 billion. It could also boost GDP by a modest sort of 10 basis points. So this doesn't really revive the European economy, but it is helpful. But I think the key line is here is that it could offset nearly a quarter of U.S.-related exports from U.S. tariffs from the European Union. So again, part of that sort of broader effort to diversify away from the United States, and for the Europeans, also China.
Yeah, Ollie, I find it amazing that some of the tariffs mentioned here are coming down to 50%, which gives you a sense of just how high they've been. And you gave us a flavour of that a moment ago. What might be the wider geopolitical impact of this deal? Because there's a lot of political signal in this.
There's a lot of political signal, Anna. So there is the economic side of this, and there are sort of varying degrees to which it will be impactful. Obviously, it's very helpful for European companies, the European economy more broadly, a little bit, still helpful, but not, that helpful. But again, it's a political signal, and it's a signal that comes just a couple of weeks after the EU signed that massive trade deal with Mercosur, Latin America. These were both trade deals that have taken more than 20 years to get over the line, and then within quick succession, within basically a month and a half of each other, they both get signed after a year of basically drama from the Trump administration across all of the tariffs, a sort of story that is not going away. This is a signal both from the Indians and the European Union. India still faces a 50% tariff from the United States. The EU has still put on ice their trade deal with the United States after the sort of a disagreement on Greenland last week. This is all about opening new markets and being a little bit more pragmatic. There's also a security and defense pact as part of the conversations that's happening between the EU and India. This is also for the Europeans to try to open up the sort of military market in India a bit more. We should say that much of the sort of military equipment that the Indians buy is currently coming from Russia. The Europeans would like to sell some of that. We should also say that they're not totally geopolitically aligned as a bloc, whether it's the Indians and the European Union. They, for example, were trying to get wording together on the sort of war in Ukraine, on the Defense and Security Pact. They were unable to do that. So for the Europeans, potentially being a little bit less principled, a little bit more pragmatic in the era of Trump and MAGA.
Oliver, thank you very much indeed. Our chief Europe correspondent, Oliver Crook, joining us from Brussels. Kind of feels like it's part of the diversification trade, which everybody is trying to figure out right now. Politicians, market participants seem to be putting the same trade on. Another aspect to it, obviously, is what is happening with the dollar right now. The euro is a beneficiary of that. We've seen prints overnight of 119 euro dollar. We've just fallen short of that this morning, but it does seem as if the euro is moving in an upward direction. What impact does that have in terms of the investment philosophy that you want to be thinking about? Isabel Mateos-Ilago, Group Chief Economist of BNP Paribas, joining us around the table. Good morning.
Good morning.
What is the impact of a stronger euro? Because we've got 119, feels like we're going to go potentially higher. Is this a positive or a negative for the European economy? It has an impact on inflation, it's going to have an impact on exports, it's going to have an impact on growth.
Well, first and foremost, the moves in the exchange rates are an outcome. Right? And they're an outcome of improved sentiment towards, in that case, the Eurozone. And I think it reflects that there have been a lot of positive surprises in the news flow, in the data flow in recent months. And markets are catching up to this, and hence the euro appreciation against the dollar. I wouldn't make too much of a big story around this, because what we've seen really is more broad-based dollar weakness.
So is it a positive story about the Eurozone, or is it just a negative story about America? Because if we have a higher currency and it's not a positive story, then it feels like it becomes a negative story.
That's right. But so certainly the news flow around Europe has been very encouraging in the last few months. So for us, it's been the market catching up with a view that we've long had. The news flow, by the way, about the U.S. hasn't been bad either. I mean, the economy looks in really excellent shape. But as you say, investors had been perhaps very focused on the growth story in the U.S., less around the rest of the world. We see a rebalancing really at the current levels, and probably the FX, the euro appreciation story has a bit more legs. You know, we have a target now at 122 in the near term. Yeah. It's not a headwind. It's not a significant headwind for anything. If anything, it's going to prevent the ECB from being too worried about maybe, a little bit upward pressure from recent energy price dynamics. It's not a concern. The concern would be if this goes much further in the absence of a strengthening growth picture. I'm not going to put a price on it. 122 is not a concern.
Okay. So we get to 122 in what time frame? And does that also mean you're not concerned? 122 is not a problem for corporate earnings?
Look, as long as you see this momentum in corporate earnings, it's not going to be like you're going from 119 to 122. Anybody who has a 6 months time horizon, okay, maybe that's going to be a big deal, but for the vast majority of actors, it's not significant. The other thing that I would draw attention to is, and for Europe, it's very important, the renminbi has been appreciating. The People's Bank of China has been allowing the fixing to, fall below 7. It's very meaningful, and for the competitiveness of European exports globally, not just in China or in Europe, but globally, it's very meaningful. So we shouldn't be overly focused on the euro-dollar parity. What's happening to the renminbi is also very important, and recently it's been going in the right direction.
Yeah, that's really interesting, isn't it? In terms of the policymakers in Beijing more comfortable with a slightly stronger currency, what that means for exporters for Europe to China. What is giving all of that? Tie that all together and give us your outlook for growth for the eurozone for 2026. Where do you see growth at the end of this year?
So we still don't have, obviously, the end 2025 number, but we expect that, which we'll find out later this week. But we see very strong growth momentum in the third and fourth quarter. So we see 1.5 for the full year average 2025, and we see further strengthening to approximately 1.6 this year and next. So and this is probably a little bit still more optimistic than the rest of the market, but we've been proven right so far, and really all the data points in that direction. So solid growth outlook for Europe.
And is there upside risk to that, given what's going on in Germany, or not? I mean, how much certainty do we have, Isabel, about what Germany will deliver, both for its own economy and the extent to which it will lift all boats in the Eurozone?
So the Germany story is very important, and that's been primarily a public spend story. Based on the latest numbers, there's actually been a bit of an underspend compared to targets in 2025. So we have to see if there's some catch-up. We're reasonably confident that we can see some catch-up because the regulatory hurdles that many people had warned about would slow down spending are being addressed. So that's very important. But there are positive developments not just in Germany. So we actually see Germany going from 0.3% growth in 25 to 1.4 in 26. That's a big jump. Germany hadn't contributed to Eurozone growth at all in recent years. Now it's going to be a big contributor. But France is also picking up steam, with the political uncertainty, as you mentioned, being reduced. So we see very good momentum in the French industry in particular. And the rest of the Eurozone is benefiting from all these pragmatic efforts which are being deployed at the EU level to make life a little bit easier for businesses across a range of sectors. And then there's momentum to sign more trade deals. So I really think what we're observing in Europe right now is policymakers, both at national and EU level, making growth really the top priority, which hadn't been the case until now. And I think we're going to see this in the data.
So that pragmatism might actually show up in the European economy and the data we get. You mentioned trade, and going back to where we started the conversation about the impact of trade, it always amazes me that they get such fanfare, trade deals. They don't tend to... Do you see the evidence of trade deals, the positive evidence of trade deals when they're signed in the data? Because stocks don't tend to rally on trade deals, but they certainly drop on trade threats, or at least they do for a very short time now. How do you contextualise trade deals, such as the one we see between India and the Europeans?
So I think the analysis that Oliver Krug gave earlier is exactly right. The importance is principally of geopolitical nature. The benefits you're going to see over a 5-10 year period, not in 2025. In fact, probably won't come into force for some time. But the signal to European corporates that, look, despite all the political hoo-ha around Mercosur, we're undeterred. We're going to keep, working to lower trade barriers with large markets like India. This is very significant. Very significant also, India had been one of the most outspoken critics of the carbon border adjustment mechanism. Turns out that didn't get in the way of a trade deal. So that's a positive signal. It's a signal to China as well, because Europe is getting into a more, I don't want to say antagonistic trade relationship with China, but there are serious issues to be addressed. And it's a signal to China that, look, we have other options. And so I think this is strengthening Europe's hands in its relations and its trade relations and geopolitical relations with everybody else. And that's the meaningfulness of it.
Can Europe diversify away from America? Is that a realistic prospect? America, this high-growth economy, looks like next Fed chair is going to run it hot. Is that something you want to diversify away from?
Well, it depends what your starting point is, right? If you're...
the starting point is today.
The starting point is today. Look, this, as an investor, most investors we know have had over a very large exposure to the U.S. economy in recent years because it was the only growth story, and now you're seeing growth pop up in other parts of the world. I think it makes sense for investors to want to tap into these other growth stories as well and rebalance accordingly. But also very important, what we're seeing is a slight disconnect between desire to have exposure to U.S. assets and desire to have exposure to the dollar. And we're seeing, people being quite positive on the U.S. growth story, at least in certain sectors, notably everything adjacent to AI, but having some concern that there could be more downdraft impacting the dollar and therefore hedging their currency exposure, even though they're retaining the exposure to the economy itself.
Isabel, nice to see you. Thank you very much for coming to see us. Isabel Mortier, City Largo Group Chief Economist at BNP Paribas. Thank you very much indeed. Coming up, David Solomon weighs in when it comes to global risk.
There's a lot going on geopolitically. There's a lot going on in the world. And as that stuff plays out, it can lead to speed bumps or, distraction. People move forward when they're confident. The noise sometimes can sap confidence. I think at the moment, generally things look relatively green, but that doesn't mean there aren't issues that could pop up.
He's constructive on the US economy. We're going to talk about what that means for your asset portfolio. That's next. This is Bloomberg.
today you don't want really to buy euro. RMB maybe too early. Japanese yen under pressure, too much in my mind. So the alternative is gold. We are allocated to gold for the last 2 years and a half.
Yeah.
And I think it will continue because gold on the long term is a very good protection against debasement and it's a good way to maintain some purchasing powers.
Amundi CIO Vincent Mortier speaking to Bloomberg Television, of course, earlier today. Let's talk about the markets. We'll do that in 3 minutes with our Markets Live executive editor, Mark Cudmore. Mark, good morning to you. Incredible tariff stories that do and don't make impact on markets. But I'll start with the line we just had there from Vincent Mortier talking about gold. Gold doing well again today. Silver really volatile yesterday and incredibly volatile once again today. Now up by 8% as I look at my screen this morning. Your latest thoughts on precious metals and how long this runs?
Well, I thought it was interesting, that quote. He said he got in 2.5 years ago, which I think would put gold below $2,000. So he's up 150% in that trade. So no wonder he thinks it's good. And I think that gets to the point here is that the move into gold and silver has been entirely logical over the last couple of years. You know, I'm not saying I've been a big pusher of it. I tend to kind of stay away from the precious metals to my regret. But my team has been pushing it quite aggressively the last couple of years. And that's my one concern is that this has been such a long established trend that everyone is very much involved in it. It doesn't mean that it's suddenly vulnerable, but it means there's probably less juice in the upside, and it means it is probably we're getting to that more volatile stage. So look, it's still fundamentally logical. People want to diversify away from the dollar. There are not great fiat alternatives, so precious metals is a clear home. With the price action right now, if you haven't been in for the last 2.5 years like Amundi, I'm not sure this is the time to suddenly get involved enthusiastically.
Mark, morning, it's Guy. Is every day Taco Tuesday now?
Certainly today was really quite incredible, where we started the morning in Asia with these 25% tariffs on Korea was the headline, was the threat from Trump. And Kospi finished up 2.7%, really quite incredible. And this comes in the back of, you know, what's happened around Greenland, the threat of 100% tariffs in Canada over the weekend, which Canada is kind of seems to be kind of shrugging off. So suddenly everyone's no longer as worried by these tariff threats. Now, it's really important before people get too carried away that, hey, wait a sec, if 25% tariffs on Korea got a 2.7% gain, what would happen if they got 100% tariffs? We need to emphasize that the extraordinary gain in Kospi here was really because the market is very much dominated by a couple of stocks, and one of them is SK Hynix, which surged today. And therefore, that kind of points to the fact that the AI theme is still ultimately what's really driving everything in markets over the last year. Not so much the geopolitical noise. The geopolitical noise causes all the disruption, and that's what traders need to care about. But for long-term investors, they need to care about the AI theme, and that's what's driving the Kospi.
Mark, does that mean that the tech earnings out of the US this week are going to be front and centre for you, or is it the Fed, or is it JGB auctions, or is it something else?
So, again, it depends what your time span is. So if you're an investor, you want to check those earnings. They still say that we're in the inflationary stage of the AI bubble, which I think we are in. As we've talked a lot about, Tom, going to the end of last year, I think the macro backdrop for global stocks is incredibly good. As you know, I think the rest of the world continues to outperform US stocks. But generally, we've got good growth. We've got fiscal expansion almost everywhere. You know, the AI theme is still in the expansionary phase. So I think as an investor, it's still a big positive macro backdrop. From a trader, I think there are a numerous number of risks in the short term. And this is why I think the volatility we're going to see it increases. So I'm very wary of the JGB auction tomorrow, probably more so that than, in fact, than the FOMC. And I don't think earnings will be a big driver for a trader because I don't think the AI bubble blows up this week.
OK, Mark. Well, that's a relief, Mark.
Yeah.
Mark Cudmore, thank you very much. Bloomberg Markets Live executive editor Mark Cudmore. The AI bubble not blowing up this week. Remember, you can get up-to-date analysis and insight from Mark and the rest of the team. Just go to MLIV Go on your Bloomberg terminal. Let's cross over to Chloe Millet right now for some stocks to watch this Tuesday.
Good morning, Tom. Let's start with PUMA today because Anta Sports became the largest shareholder in the company, taking a $1.8 billion stake in PUMA. And this is likely to really boost the shares in PUMA this morning after, as we can see, quite a long period of sustained weakness for that company. And analysts are saying that this purchasing of a stake by Anta Sport really boosts, it signals high hopes of a turnaround at PUMA. And this could also potentially pave the way for a full takeover of the company, although Anta Sports has said that it market is not considering that at this stage. Moving on to car makers, and they could also get a potential boost today because car sales in Europe rose for the third year in a row, and that is thanks to strong demand for EVs and hybrid vehicles. And although this is still below pre-pandemic levels, we could see sales getting a boost from the €3 billion subsidy for EVs that we'll get in Germany. And this could potentially be positive for all of those names up here on the board. And finally, Burberry is also in focus today after getting a new buy rating from Barclays, and that is just a week after reporting a very strong sales, and that boosted investor confidence in a broader luxury turnaround. And we'll get that theory tested later today when we get LVMH earnings after market. I'm sure that we'll talk about it tomorrow, but in the meantime, Burberry might get a boost this morning.
OK, thank you very much, Chloe. Chloe with the latest there on what's going on in markets and the stocks that we're focused on. Over in India, in New Delhi, we have the European Union and India set to sign a new trade deal. We have there represented on the stage, you can see the European Commission and the European Council, presidents of both, Narendra Modi, the Prime Minister of India, of course, and they look set, Tom, to sign a deal that they've been talking about for 20 years and finally finding it within themselves to get it over the line.
Yeah, it could boost India's exports to the EU roughly about 50 billion US dollars in a particular time frame. It's going to take about 6 months to vet, and then the EU Parliament has to sign off on it. But we continue to monitor this, the mother of all trade deals, according to the EU. Coming up, it is the opening trade. Futures currently pointing up 0.3%. Stay with us. This is Bloomberg.
Welcome back. A couple of minutes to go until the equities start trading. But I want to take you to New Delhi, where, as you can see, we are signing documents, exchanging documents. The trade deal between the EU and India finally is here after 20 years. A big moment in terms of the diplomacy. Will it have a big impact in terms of the economy? That maybe will take longer to determine. But it feels like it's part of the diversification trade, which is ripping through markets right now and is once again evidenced in what we are seeing around the world. This is the session yesterday. Equities beginning to gain a little bit of traction, couple of negative weeks. We're starting to get a little bit of growth coming through on the equity front. But as you can see, little sell-off into the close. How does Europe price that? Where are we going to go to today? It looks like we're going to be a little bit higher. And there's a bunch of single stocks that are quite interesting, Tom.
Yeah, Guy, futures in Europe then pointing to a pretty solid session then this Tuesday, up 0.3% on the benchmark in Europe. The FTSE 100 looking to add 35 points, pointing high by 0.3. We'll be watching, of course, the miners, given the rally that we're seeing in silver and gold. Copper, though, a little softer in the session. DAX futures pointed to gains of about 0.2% over in Germany.
Tom, let's talk about some of the individual stocks in focus and indeed one sector. But let's start with PUMA, because this could really be a mover. China's Anta Sports has agreed to buy a stake of about 29% in PUMA. And crucially, they're buying this at €35 a share. The stock closed at 21.63. So we're looking for some upside there. Burberry in focus. That stock raised to overweight at Barclays. The turnaround story under the new CEO certainly getting a lot of attention for this UK fashion brand. And we're also keeping a close eye on what's going on with European cars. European car sales rising for the third consecutive year, something of an EV recovery, it seems, certainly for cheaper car models. Guy.
Let me just add Sandvik to that list. It could be an interesting one as it opens up. Mining materials, certainly in focus. OK, let's dig into these markets. Let's see what's happening. These are the numbers. We are, as we can see, with the FTSE 100, fairly flat, but positive. We are starting to see maybe equities gaining a little bit of traction. And this is overnight. We've seen euro dollar go to 119, which is interesting. Are we going to see further momentum? Are we going to get up to the target we heard from BNP a little bit earlier on, 122? Do we go beyond? What impact will that have? The 600... We'll wait for some of the other markets to settle in and see what happens there. The CAC 40, we are waiting for LVMH after the close today. That is a big moment as well, as we await the big tech story coming out of the United States tomorrow. The IBEX is up by 0.4%. We'll wait for the SMI and Germany to open. Germany's going to be really interesting today. Plenty of stocks in focus there, including, as Anna says, PUMA. Tom, what do you got?
Yeah, before we get to the tech names on the US on Wednesday, of course, it's SK Hynix steaming high, and that's led to gains across the tech space in Europe right now. Sectors Across your sectors, top of the list is tech, gaining more than 1%. Banks also doing quite well as well. HSBC seeing a pop in their share price. Banks up 0.8% as a sector. On the downside, basic resources down by 0.7%. Copper and oil under pressure in the session today. We'll see how silver is reflected in some of the names like Fresnillo. Fresnillo's actually down 1.8%. Antofagasta also down around 2%. Anna, what are you looking at? What's standing out to you?
It's almost, has all that volatility in silver just got a little bit much for some people? Because, yeah, it's quite surprising on a day where silver is once again up by 8% or more. The basic resources is the worst performing sector. It's down by 0.7% as a whole. Interesting, within that technology space, there's no doubt the global story, the Asia story that you nodded to there, Tom. Also, if you click into the sector, Sage Group is the best performing stock. And this is a business that's very European, but also very North American. And it's been questions around such businesses that do software, essentially, and how they perform in an AI age that have maybe been dominating some parts of the tech conversation. And this company, fairly small by European standards, but out with updates today, reiterating full-year guidance, and the stock managing to go a little higher, up by 3%. So that's the best performer on that tech index.
Techs and banks up. It's interesting that we are seeing some of the pharma stocks up. Can I draw a line to India on that one, maybe? Maybe there's a sort of pharma element to what we're seeing there. I don't know. Or maybe we're just, as a group, buying back into that space. You are, though, seeing some weakness in some of the staples. Some of the energy stocks are also giving back some of the ground as well. So in terms of what we are seeing, it certainly kind of feels like a more risk-on market. Tech feels like it's on the front foot. That definitely feels like it's risk-on. The banks are also into the mix as well.
And we'll bring you the move on PUMA, of course, when it's reflected. We know that pre-market it was pointing high by double digits on the build-out of the stake by the Chinese company Anta as well, but waiting for that to reflect. Not coming through yet, but we'll update you when we get that.
Absolutely. So let's get a perspective on these markets. Richard Saldana joins us, Global Equity Fund Manager at Aviva Investors. Richard, nice to have you with us. We have seen 3 years of strong moves in global stocks, and I've read notes from a few people this week that have made that point at the start of 2026 in order to then set up their view for 2026. Does that matter? Is that material? Are we still is it a cyclical conversation we're having, or is it more structural for 2026?
Yeah, so look, I think that's the question that's on everyone's minds right now. I think one of the themes that we were sort of certainly pointing to last year, but also coming into this year, was that theme around diversification. So to your point, in terms of, what was driving that strong performance we've seen over the last 3 years, or the majority of the last 3 years, it's been that the US equity market, right? And obviously that's led to questions about US exceptionalism. But I think what was interesting last year is you definitely saw a changing of the guard, right? If you think about the regional performance, obviously you saw Europe, UK, Asia and emerging markets outperform the US, not just in US dollar terms, obviously given the dollar weakness last year, but even in local currency terms. So you did see what we think is a changing of a guard in many ways, and obviously that has continued to play out this year, particularly against that backdrop of geopolitics.
Yeah, what did you take, Richard, away from the fact that we worried a lot this time last year about too much reliance on the Mag 7, and then we managed to pivot actually away to a much wider basket of tech names and a wider geography than just the United States, and markets didn't fall over? I mean, what did you take away from that?
Yes, so look, I think the key takeaway from us was the broadening out, right? So if you think about what was the reason why the Magnificent Seven stocks outperformed so much, it's because they were the big driver of earnings, right? If you think about where the bulk of the earnings growth is coming from, it was very much concentrated in those stocks. Again, particularly towards the latter part of last year, you definitely saw a broadening out of that earnings growth, and you started to see that as well if you think about even the beginning of this earnings season. So I think in our mind, that's really what's going to keep underpinning this broadening out story. It's going to be earnings driven.
So, Richard, just in terms of time frames, that continues. So you're talking about diversification. Where are we in that story, and where are we in the broadening in the AI story? Yeah, How much further do those two themes have to run?
Yeah, look, to use a baseball analogy, I'd suggest we're pretty early innings in terms of that diversification theme. And the reasons behind that is actually, think about the starting point. You've got a global sort of equity, if you look at some most global equity benchmarks, still around 2/3 in the US, right? So again, we think about the backdrop right now, whether it be the foreign policy uncertainty, questions over central bank independence, some of the fiscal question marks as well. That diversification theme, we think, makes a lot of sense and will continue to make sense. You also put the context of valuations. Again, you look across most valuation metrics, the US market certainly looks still relatively extended, certainly relative to Europe and certainly relative to emerging markets as well there. So I think that's going to continue to underpin that diversification and broadening out theme as well.
Which FX trend are you most focused on that could impact that view?
Yeah, look, I think the dollar is clearly going to be key, right? But I think it's interesting, again, I think the geopolitics is also driving some of that. Clearly, we've seen that dollar weakness last year. We saw last week as well the dollar relatively weak against that backdrop. So I think people to some extent are starting to think about, that US exposure, perhaps applying a bit more of a risk premium towards that. And that's clearly impacting as well some of the currency metrics.
Do I just want to sell any dollar asset? How big an impact is it going to?
Yeah.
Equity markets, S&P 500, in nominal terms up 1.53, in euro terms up by 0.5%. Big outperformance coming from European indices as a result of that. The US looks like it's the AI trade, it's all these there's lots of things going on. But if it's priced in dollars, do I want it?
No, I think that's a really good question. I think it's something investors are asking themselves. I think just taking even the currency part aside for 1 second, again, look, we know what themes are going to continue to underpin this market, certainly the AI story and that CapEx story. But I think, again, thinking about the broadening out context, right, it's not just about those Magnificent Seven companies. It's not just about the hyperscalers. You start to think about areas such as, whether it be memory, again, the Korean names come into play. We talked obviously about Hynix and the likes of Samsung as well. You start to think about areas such as semiconductor equipment, whether it be things like lithography, deposition, companies such as ASMI, ASML very much come into play in Europe. So I think that sort of broadening out is not just a regional perspective, it's also a sector perspective as well.
So, okay. So I want to buy the AI trade, but I want to buy it outside America, basically.
Well, certainly you can continue to have exposure within the US, but you can diversify outside.
Am I going to get a better performance outside or inside the US, do you think, this year?
Well, so I think the question mark for us is, I think given how much those US stocks, particularly some of those big hyperscalers have run, I think the argument actually is you start to look, particularly from a valuation standpoint, and I think Asia in particular starts to look very attractive on that perspective.
In terms of, so you've talked about earnings and how important that's been to where we've seen outperformance from stocks, and we're going to see corporate earnings from the tech sector this week. We were talking to one of our colleagues yesterday analysing tech names, and he was saying this is going to be a real show-me quarter. There's been so much CapEx spent by these names. Yeah. And I appreciate that, we've broadened out the conversation now. But in terms of the CapEx that these businesses are spending, I mean, what are we going to be watching for around that CapEx theme? Because sometimes the market can take really big CapEx numbers, and sometimes the market says, no, that's too much.
Yeah, no, so look, I think we're shifting. Obviously, last year, clearly there was a lot of focus on that CapEx number. That still remains well underpinned. I think if you look at the sort of, call it the big four across those sort of names, whether it be likes of Amazon, Meta, Google, Microsoft, you're still going to see close to probably $500 billion in terms of CapEx. So the numbers are huge, right? But I think what the market is really going to be wanting to understand are a couple of things. One is, where is that CapEx coming from? And again, if it's still coming in terms of, cash flow generation, this isn't companies taking on additional debt. So I think that absolutely matters. Now, the second point is about the revenue linkage, right? So people are starting to think about, when are you going to start recognizing the revenue from this CapEx expenditure? Again, the more detail you can start to get from the companies in terms of that revenue recognition, and obviously a lot of that is going to depend on the enterprise adoption phase, that's clearly going to be something on investors' minds.
How long have they got on that question?
Yeah, so look, I still think there's still, in terms of that runway for CapEx, you could still be talking a couple of years at least when you start to think about still that data center build out. It's still relatively early, right? So I think as you start to think about probably that enterprise adoption, that still could be very much a 2027, 2028, frankly, story in terms of that. But I think in the meantime, the likelihood is you're still going to see these companies invest in terms of building out that future capacity.
You're constructive on equities. Where are you finding downside protection?
Yeah, good question. I think that downside protection part is really important. And it ties back to what you were saying, Anta, at the beginning about, look, we've had clearly a very strong period of performance, 3 years now of 20% plus returns in sort of dollar terms for global equities. So downside protection should be, investors should definitely be thinking about that. Look, I think a couple of sectors just to highlight. Consumer staples, very unloved right now, but on a relative valuation basis, trading on sort of relative multiples, relative to the broader market at decade lows, right? Multi-decade lows. So again, you want to be selective there. We're looking at companies, particularly with emerging markets exposure, where the consumer still remains relatively strong from a sort of spending perspective. So companies such as Unilever, Reckitt's, even here in the UK, Colgate in the US would be an example there. So staples, I think, could offer you some protection, almost a hedge somewhat against some of this volatility and geopolitics that we're seeing. And I think healthcare still has appeal. I mean, we think about last year, it was almost the perfect storm, whether it be, tariffs, drug pricing, healthcare reform. But we still think sector from a valuation perspective, is attractive, and you're still seeing companies delivering good cash flow and dividends.
Relative protection? Or
it's relative protection. To be very clear here, that's relative protection. But look, we've seen in the past.
Where do I get absolute protection? How do I protect a portfolio in absolute terms?
Well, I think then you'd be looking at certainly things like metals, etc. You'd be looking at that sort of hedge, whether it be gold or other things like that. But I think
they all look pretty choppy as well, pretty high as well.
They do.
Choppy.
They do, and there's a lot of momentum certainly behind that trade as well. But look, I think from an equity perspective, when you're thinking about defensive sectors, certainly those two. And we even saw that last week when you saw that kind of on Tuesday. It feels like an eternity ago when the markets dropped on that Tuesday. Where did you see the defensiveness? It was certainly Staples, was an outperformer that day.
Great to see you, Richard. Thank you very much indeed for coming to see us. Richard Saldano, Global Equity Fund Manager, joining us from Aviva Investors. Let's take a look at what the Core 6 looks like this morning. With some quite interesting divergence emerging. Certainly chips are back on the front foot. ASML is up quite strongly. Big day tomorrow, but big day today out in Korea as well. That's manifesting itself in a big performance from ASML, one of the big gainers. LVMH is weak into its numbers. So we get those at around kind of 4:40 London time, a little bit later on. That's the story for tomorrow. We'll talk about it in more detail in just a moment. But LVMH, a little bit of selling coming through as we see the numbers coming into view. Chloe Melly's got more on what stocks we're watching. Let's start with Puma and figure out what is going on with that stock.
Good morning, Guy. Indeed, Puma is, as expected, moving quite strongly this morning, up more than 10% after China's Anta Sports took a controlling stake in their company, a stake of $1.8 billion, becoming a top shareholder in Puma. And this could potentially pave the way towards a full takeover of Puma, although Anta Sports has said it is not considering that at this stage. And in the meantime, it taking this big stake in the company is seen as signaling high hopes for a turnaround, and therefore we are up very strongly for Puma this morning. Moving on to Burberry, which is also in the green after being upgraded to a buy rating by Barclays analysts. It seems that this turnaround story with the new CEO is something that analysts have quite a lot of confidence in, and we are up about 1% for that luxury company ahead of LVMH earnings coming later today. Moving on to another company that's in the green, and that is Legrand, which is a maker of data center equipment, and it was placed on positive catalyst watch by JP Morgan analysts, and therefore we are up 2% ahead of those earnings. Cranswick is also in the green. Cranswick, a producer of meat, of poultry, of pork, and it said that profit will be at the top end of expectations, and that is because it is really benefiting from this big kind of protein protein moment, and we are up about 2% for that company. And finally, let's end on a company that's in the red, and that is Evoke, the gambling company. It reported numbers that were a little bit disappointing. It said back in December it was considering selling the entire business, and it said today that strategic review was ongoing, and we are down quite significantly for that company, about 9% this morning.
Chloe Millet, thank you very much indeed. On the protein trade and others, some have been bulking up. Guy Johnson's been loading up on the protein bars and the turkey meat. Coming up, as we've been hearing, China's Anta Sports has become the top shareholder in Puma. We're going to have more on that story. Is it a takeover target? That's coming up. This is Bloomberg.
Welcome back, everybody. This is the opening trade, 8:17 in London, Tuesday, 27th of January. And European equity markets on the front foot, not by a huge amount, but pointing a little bit higher. Nasdaq futures, interestingly, up by 0.6%. E-minis up 0.3. Guy, should we talk about cars?
Why not? Let's talk about what is happening in the European car sector. It looks like data is signalling that actually we had a third year of growth last year, but actually we're still, before you get too exuberant, are basically below where we were pre-pandemic. Affordable electric certainly seems to be doing well. Hybrids definitely having a good performance at the moment. Joining us now with details, Danny Lee. Danny, what are Europeans buying, and what does that tell us about kind of where we're going next?
Well, the Europeans have been buying into that Chinese EV story, more affordable EVs, and you've seen the response from European automakers with those sub €20,000 models, which have really taken a hold in Europe over the last several months. And we have seen, as a result, the 6 straight months of growth in new car sales across Europe. And it's that now great competition which has then allowed EVs, pure EV sales to jump 30% year over year in 2025. And hybrid sales, a combination of hybrid sales, has made it become one of the best-selling items in Europe from a cars perspective. So they've taken up 45% of all new car sales across Europe in 2025. So it does leave those petrol and diesel cars in the minority, and therefore that real rapid change and transformation of the European car space kind of feels like it's leaving some of those European legacy automakers behind.
Yeah, all right. Good news for pollution, good news for consumers, Danny. But maybe, to your point, a challenge, of course, for the industry of Germany in particular, but more broadly, the auto industry of Europe. What are governments doing? Are we seeing additional measures coming through to support the auto industry?
Well, yeah, you make a great point about Germany, because they've just recently announced 3 billion euros in subsidies for new EV purchases. And critically, this permits the Chinese EV makers to benefit from this massive subsidy that Germany wants consumers to buy more into EVs. So we could very well see more momentum into EV sales thanks to that strong showing the back end of 2025. That momentum could very much continue to 2026. And it's not just Germany. We see the likes of France and the UK, major auto markets where governments are showing support for consumers in allowing them to buy electric vehicles with some handouts. So yeah, there could be some more momentum. I think the key question really is about tariffs, though. Because of those exports from China into Europe, there could be a settlement between the European Commission and automakers from China, so that could help lower prices and give more predictability in a market where there was some friction.
Yeah, these European legacy automakers, they make plenty of electric cars these days, but there is increasingly a presence for new entrants or presence of new entrants. So BYD, their European car sales tripling, the car maker aiming to sell 1.3 million cars outside China. So with this performance in Europe, Danny, how close do they get to that target?
I think for BYD, the chunk of sales from Europe has been sizable already. They've had really good success, and you've seen that in the European sales numbers. And they sold 1 million units outside of China in 2025. They've raised their target in 2026 to 1.3 million. You can sure bet that BYD will be targeting Europe aggressively. It will be a fairly open market compared to 2025, and it will be following its rivals in trying to challenge the European automakers to have even more share and lower pricing in order to stimulate that sales number. And it hasn't got anywhere without being very aggressive on pricing tactics to make it be one of the world's biggest EV sellers around the world.
OK, Danny, thanks for that update on the auto sales out of Europe, what it tells us about the trends going forward as well. Danny Lee joining us with the context. To the retail space now, PUMA shares are surging after news that China's biggest athletic apparel seller, Anta Sports, agreed to buy a stake of about 29% in the German brand. The €1.5 billion deal would make Anta Sports the largest PUMA shareholder. Joining us for more is Bloomberg opinion columnist Andrea Felsted. What is the appeal, Andrea, for Anta in building this stake out in PUMA, and ultimately are we on track for a takeover essentially?
Anta's really keen on this because in China everything is Gorp core. It's hiking, running, outdoor wear. So that's why it's targeting PUMA. Now the thing is, PUMA doesn't actually have a very strong position in that market. PUMA has more products in the fashion lifestyle sector, and that's the sector that's really under pressure from changing fashion tastes, where we are ditching our sneakers and going for proper shoes again.
You said what was the focus? Something core, Andrea, which went completely over my head.
Gorp core, it's kind of dressing for the outdoors, hiking, running, all those types of things.
OK, excellent. Just to clarify.
OK, let's go kind of away from Gorp core. We're about to get LVMH, then we get Kering, then we get Hermes. What is the setup into these earnings numbers? What do analysts need to see? What do investors need to see? The stocks have done OK-ish. Year to date, not so good. But what is the setup into this?
Well, the stocks have rallied a lot from last summer when everyone thought no one was ever going to buy luxury again. Investors have realised actually the luxury, industry does still have a pulse, and the stocks have come up accordingly. But now we're at the point where they're probably up with events, and we need from these numbers some reassurance on China. China's not getting any worse, but it's not clear that it's really rebounding. We need some comfort on the US. Don't forget, go back a year ago, there was lots of optimism about the US luxury market. We'd had the election, that unleashed a wave of spending. We're up against those tough comparables. We've had a little bit of wobbles in markets last week with the political tensions. We'll need to see that hasn't derailed things. So I really think it's, can the next leg of this recovery continue?
Seeking comfort from luxury.
Yeah. I want to ask about, Anna has a sensible question, but baggy trousers, is that a long-term trend, Andrea? I'm still on the shelf, on the fence, on the shelf. Do I go all in on baggy trousers?
No.
I have one pair, but I'm not convinced.
No,
my 14-year-old does. I'm just going to point that out.
Okay. So that's a good gauge, because he's probably ahead of the trend.
Don't buy more. Silhouettes are slimming again. We are peak baggy. We have seen, the big thing, so we've had the 90s. The next thing being tipped is the 80s. Big shoulders, cinch waist, and
the 80s were amazing.
And a slimmer silhouette.
The 80s were amazing.
This feels like a trend we can definitely lean into. I feel like it's a...
I've still got some of it. What are you talking about?
Recycle it. It's a bit of a problem, though, for people of, I'll say my age, because I don't want to put everyone in the same bracket. You don't really want to feel too ahead of these trends, do you? Because then you just look a bit ridiculous, Andrea. That's the risk. To be ahead of an 80s trend. She says, sitting here with slight shoulder pads.
But then again, everything's so expensive. Everything's gone up so much. You want to have a little bit of ahead of the trend, because then you'll get your money's worth.
So, so 80s, what am I buying if I want the 80s?
It's shoulders, waists. It's really that big.
Is that for me?
Big jackets.
Big jackets.
Shouldered, maybe a slightly
remember the big
baggier
sort
silhouette.
of big jacket, the sort of oversized jackets.
Exactly. That's it. It's really it's all about the sharp shoulders.
Okay. Andrea, thank you very much. You see, I love these conversations with Andrea Felsted. They always start somewhere entirely sensible and news-based, and then they stay sensible in a sense, but very useful. Thank you very much. Bloomberg Opinions, Andrea Felsted, with all the advice you need on fashion. We've been talking about global trade today in the context of an EU-India trade deal. Let's listen in briefly. Ursula von der Leyen, Commission President, of course, signing that trade deal with Antonio Costa, with Narendra Modi. Let's listen in to what Ursula von der Leyen is saying.
Our greatest wealth are our people. That is why I'm so glad that we are signing an agreement on mobility. We will facilitate the movement of students, researchers, seasonal and highly skilled workers. And this is also why we are launching the first EU legal gateway office in India. It will be a one-stop hub to support Indian talent moving to Europe in full alignment with EU member states' needs and policies. This is good for our economies. This is good for the friendship between our people. And this openness benefits us all. As we conclude this 16th summit, let me reflect on another event of deep meaning. 2 weeks ago, India marked
the EU Commission President, of course, Ursula von der Leyen, talking about what she's described as the mother of all deals with India. Is that part of the diversification trade? And is gas and is energy for Europe also in focus? We're going to get some details, some analysis in terms of LNG imports into Europe. Stay with us. This is Bloomberg. Welcome back. This is the opening trade. We are 30 minutes into today's session. So the earnings story front and centre, the AI trade in Asia giving that region a decent lift in the session today. You have green on the screen in Europe. It's pretty modest, building on the soft upside that we saw yesterday. Gains of about 0.2 yesterday, upside to 0.2 so far today. So the direction of travel is still upwards, but of course we have the Fed to contend with, the earnings story as well. The DAX up just 31 points, 32 points. Over in France, the CAC 40 is essentially flat. The FTSE 100 gaining 0.2%. You have banks, financial services performing quite well. Technology also on the front foot. On the downside, basic resources. Guy has some more details.
Absolutely. So it's interesting. If you look at the headlines, basically what you're seeing is a market that really isn't going anywhere. If you look at the sector composition, it tells you actually maybe the market is feeling a little bit more risk on. Feels like an Asia trade coming out of what we've seen, particularly out of Korea overnight. But we're about to get big tech. So is that going to change? In terms of the sector composition, how does it translate into what we're seeing in terms of the internals? 307 up, 274 down. I'm not actually sure there's much of a lead there. Volume's a little bit on the light side. We're going into an awful lot over the next few days. Is that a signal signal there as well. In terms of the stock story, the Chinese are buying into PUMA. That stock initially much higher. It's fading that move now. Burberry is actually down by 1% this morning despite an upgrade. Sage Group is up very nicely on the back of its numbers. Accountancy software still important. And also remember, big AI component maybe going into that narrative too. Let's talk about what is happening on the downside. We've just seen what's happening with Burberry potentially being dragged lower by the big kind of behemoths in this space. LVMH is down this morning. You got to watch out for its numbers a little bit later on. Then we get Kering, then we get Hermes kind of midway through February. Rio's a little softer as well this morning. Total is down on a downgrade as well. That stock is up though. Sorry, it has been up recently. Today though, down by around 0.5%. Anna.
Guy, let's get an update on some of the other stories we're covering this morning. Speaking this morning, Indian Prime Minister Narendra Modi says India and the European Union have agreed a free trade agreement. The announcement caps nearly 2 decades of negotiations at a time of strained ties with Washington. The pact is expected to eliminate tariffs on over 90% of EU goods. The UK Prime Minister Keir Starmer says he won't choose between the US and China as he flagged, quote, significant opportunities for British businesses ahead of his trip this week to Beijing. Starmer told Bloomberg he can meet with President Xi Jinping without angering President Trump or harming relations with the United States. Starmer also told us that while the UK will maintain close ties with the US, it doesn't make sense to ignore business opportunities in China. And US Airlines are still paring back flights as a deep freeze hampers the restart of operations at some major hubs. Flight Aware indicates that American Airlines has already axed about 500 mainline and regional services today. The industry is bracing for further disruptions as another Arctic blast looms later this week. Tom.
Let's get more in terms of how we should be thinking about gas prices. And part of that is what's happening in terms of the weather in the US. Of course, US natural gas prices are dipping. Traders taking profits, arguably. Continued freezing weather conditions, as Anna was saying, across much of the US had sent gas prices up as much as 35% on Monday. Similar price reversals in European gas prices. We're seeing a gain of just 2.5% so far on Dutch gas on the pricing that I'm looking at. They're now paring back some of those losses. Let's bring in Bloomberg's Priscilla Azevedo-Rocha now for the details. Priscilla, how much of an impact are we seeing in terms of the gas markets as a result of this weather, and will it be sustained?
So gas markets are whipsawing this morning. We've seen a retreat from very high prices. In Europe, we are 40% up so far this year, which shows the volatility is back, and it shows how European global markets are now integrated. The storm is in the US. In Europe, the weather forecast is looking milder. And still, we're seeing the impact of this because Europe now relies on the US for most of its LNG purchases. So when we see something happening as far as the US, now we have an impact here.
Yeah, tell us more about how quickly that has been evolving, Priscilla, because we used to talk about these as very separate markets. The sort of landlocked hub in the United States was where we took the price for US gas, and it didn't really have much of a bearing. As recently as a few years ago, that was the case. So this has been changing since Ukraine, I suppose.
Yes, that's right, Anna. That has been changing since Ukraine, and we've seen a complete transformation in the market. Europe is now importing gas from global markets via LNG, so it comes in ships and so on. In the US, when we have a situation when we have a freeze in places like Louisiana, Texas, where most of the export facilities are, we see those facilities closing or cooling off. And this gas is being destined to local markets rather than exports. We are starting to see some mild signs that Europe is getting less gas from the US on the back of this freeze. The data is coming through this morning, but yet the prices are retreating on the fact that most of the storm now is over. And we've seen that the consequences for Europe have not been as bad after all.
Are US data centers willing to give power back to the grid? And how does this whole process work?
Well, the US last night signed an order, and they have to do it. So it for gas traders, that shows that even in the case of an emergency, there's backup supply that can be redirected for the biggest power source that is out there right now. Data centers consume a lot of energy, and they have backup systems, they have batteries, and so on.
So if I'm a data center and I have my own power supply, which a lot of these data centers are increasingly looking at, I am now required to use my power supply rather than to power my data center, but to power the grid. Is that?
Well, you're looking at hospitals, you're looking at emergency businesses and so on. It's a state of emergency.
Yeah, but that's part of the. I suppose you have to think about that when you spend all that money on putting in that facility for your data center. Really interesting, Priscilla. Thank you very much, Priscilla Azevedo-Rocha, with the latest on the storms stateside. For more on the evolving global gas story, let us talk to Jonathan Schroer, who joins us now, sustainability and energy investment strategist over at UniCredit. Jonathan, really nice to have you with us. Listening there to Priscilla, clear just how much the trade in LNG has upended relationships within the global gas market. Just how much more reliant is Europe now on US gas than it was before the invasion of Ukraine?
Well, yeah, I mean, before the invasion of Ukraine, Europe was getting about 45% of its gas from Russia, I mean, almost all via pipeline. And as they have been cutting that back rather dramatically, they've had to basically replace the pipeline gas with LNG. So now Europe's getting about 40% of all of its gas from LNG. And the share that the United States has in all of that has been growing to most recently in 2025, 58%. So when you put that together, that accounts for about 25% of the gas that Europe gets. It gets from the United States these days.
OK. And so, Jonathan, does that mean that Europe needs to start being concerned about changes in energy policy in the United States and what that might mean for the reliability of that supply? Could that trade relationship be used as a weapon?
Yes, I think absolutely. That's something that the Europeans are starting to consider more and more, especially after some of the negotiations that we've had in recent weeks or through the first year of the Trump administration. They've shown that they are willing to use geoeconomic weapons. And so whether natural gas could be the next one is a question that I think Europeans have to be asking right now.
So America's built all these trains. We're seeing those trains exporting a lot of gas onto the international markets. If Trump said you can't sell to Europe, Jonathan, who would they sell to?
Well, that's perhaps the good news for the Europeans, is that in contrast to pipelines, the way the system was really based before, with LNG, you do have a more liquid, you have a more fungible product. So they would need to sell to someone. It would be very complicated, I think, actually, for the United States to block those exports. I mean, you certainly never would want to say never. But on the other hand, the ability, if they were to do that, it would really be harming a lot of their own private companies. In contrast to something like Gazprom, which was controlled by the Russian state, most of these contracts with LNG are done with private companies. And those are companies also that have been very supportive of the Trump administration. So it is a global market.
It is a global market, and there's also an awful lot of gas on that global market. So if you couldn't buy from the Americans, could you buy from the Qataris? We've already seen a rewiring of the global energy market. If the Trump administration were to do this and say we can't sell to Europe, we just see, again, just a rewiring. The tankers just kind of, they go out of America in a different way, they come out of Qatar and they go a different way. How quickly could we reorder?
Well, I think it would reorder relatively quickly because it is a liquid market. It's very different from the situation when you're relying on pipelines. So I can't imagine that those U.S. companies would simply want to sit on that gas. It would need to go somewhere, and so gas that enters one market makes gas available in other markets. So it is a less effective geoeconomic weapon than what we had before. So yeah, that's
Jonathan. If this is a material concern in the halls of power of Brussels, do they look at rewiring the feedstock and look at nuclear energy? I mean, should we be thinking that there's going to be a build-out of additional nuclear energy? Could Germany change its rules around nuclear power, given that is a European strength and expertise?
Well, certainly. I do think that what this does is it is a warning signal, and the Europeans need to start thinking about how do they gain energy autonomy. And really the two ways to do that would be either through nuclear power or through renewables. So they really need to invest in those two. In terms of the German situation, they've repeated over and over again that they're not interested in re-entering nuclear power. In this environment, it's probably a decision they would like to have back. So, but assuming that they're not going to go back on that decision, then what I would assume is that this should give new impetus to renewable investments as a way to cut down the exposure to fossil fuels, which, as the United States gains power as a fossil fuel exporter, you basically have a situation where the Europeans are having deja vu. They've exchanged dependence on one power to another.
But can the Europeans ever build out renewables without being reliant on China?
Well, that's right now, no. They need to invest in their own technologies. So at some point, yes, they do have China exposure for those investments. It really is a matter of balancing all of these priorities off of each other. And so, yes, they would need to buy Chinese technology for the time being. But yes, I think they also need to invest in their own technology. This is something that was cited in the Draghi report. That was a special real strength of the European economy and innovation was green technology.
Jonathan, we've dealt with the sort of big picture geopolitics of all of this. In the here and now, America is contending with a storm. We've got really cold temperatures here in parts of Europe as well. I wonder what the storage situation looks like in Europe. And are you concerned that even not for sort of mercurial change of policy reasons, but just because America needs it, that gas doesn't flow quite so quickly from the US to Europe?
That's exactly the problem. Now, that would be a short-term issue. But just because of storms, because if there were a policy threat, we've seen that the price of European benchmark gas, TTF, is up 40% since the start of the year, and that's largely weather driven. There are some geopolitical factors in there with the turmoil in Iran and headlines, especially coming out of around the Davos. So. These are factors that can drive short-term surges in the benchmark gas price. The question is really whether it's going to be enduring. If we're going to talk about the impact on long-term inflation expectations, it really needs to be more than just a short-term spike. There needs to be a structural reason why it would stay higher, and then we're talking about more severe, longer-term economic consequences.
Jonathan, thank you. Jonathan Schroer, Energy and Sustainability Investment Strategist at UniCredit, with those insights and context around the complexity of Europe's energy challenge still. Coming up, how high have temperatures soared at the Australia Open in Melbourne? The answer when we come back. This is Bloomberg. Welcome back. Now, before the break, we asked you how high have temperatures soared at the Australia Open in Melbourne this week. The answer, 45.6 degrees Celsius or 114 degrees Fahrenheit for our American friends. That's as the quarterfinals, of course, at the Grand Slam got underway today. Wow. Tournament officials moved to implement cooling breaks and the possible suspension of play on outdoor courts. Temperature records tumbling across Australia's southeast over the past day due to the most prolonged heat wave since the 2009 bushfires. Interestingly, since 1950, every decade in Australia has been hotter than the decade previously. I think even Anna Edwards' killer serve would be challenged in 45 degrees, Anna.
Right, yes, there's absolutely nothing to say about my tennis game, non-existent as it is, Tom, thank you. Prime Minister Narendra Modi has been signing a trade deal with the European Union. So Ursula von der Leyen, Antonio Costa, both present in New Delhi for that. After nearly 2 decades of negotiations, the pact aims to lower tariffs on most consumer and industrial goods traded between India and EU members. Let's bring in Brendan Murray, who covers trade, of course, here at Bloomberg, and somebody we turn to at moments like this. Talk us through some of the terms of this trade deal. 20 years in the making, but strangely enough, they found it within themselves to get over the line this week.
Yeah, exactly. So this will lower tariffs on a lot of key traded goods between the two countries. It's phased in over 7 years, up to 2032. And so both sides are walking away saying, we get access to their market and they get access to ours. It's really an important symbolic deal as well, because the Indians have traditionally been very protectionist, very difficult to break in there. The U.S. has found this. A lot of other countries have run into resistance trying to open up India's huge consumer market. But now this is what they're saying. Of course, the catalyst here is the U.S.'s posture on protectionism, and all these countries now scrambling to try to figure out how they diversify away from the U.S. economy. Suddenly, these deals that have been decades in the making are starting to come together.
How's this going to go down with the Trump administration? Are we bracing for a Truth Social post from the president or even Scott Bessent attacking the EU? They have 50% tariffs on India because of Russia and Ukraine.
Yeah, exactly. The president in the U.S. definitely has his finger on the trigger of his social media account on trade lately. He went after Mark Carney in Canada for doing a deal with China, and so we'll have to see how President Trump assesses what they've got here. He very much looks at these as loyalty tests. If he sees the Europeans giving something to the Indians that they wouldn't give to the U.S., he could take it the wrong way and could fire off one of these posts.
Let's talk about Taco. Taco Korea. Market seems pretty immune to the whole Trump tariff trade now. You can see that with the Korean markets overnight. I'm just wondering if we need to put another word in the Taco. Should it be Trump almost always chickens out? Because there's some great Bloomberg economics research on this.
Yeah, exactly. So the markets in South Korea, the shares of Hyundai, didn't really react to this news that President Trump was going to slap 25% tariffs on South Korean goods into the U.S. This is the fourth big sweeping tariff threat he's laid out there this year. We heard about Iran, Greenland, Canada, and now South Korea. The markets seem to be kind of shrugging all this off. The Bloomberg economics data basically shows that it's not that he always chickens out, it's that he only really follows through 27% of the time.
Almost.
27% of the time, almost.
T-A-A-C-O.
T-A-A-C-O.
Yeah, Trump almost always chickens out. Not always, almost always.
Guy Johnson's rebranded the acronym for us.
Yeah.
Brendan, thank you very much indeed. Brendan Murray with the update on the trade front. There's a lot of trade news today, of course, that we've been walking through. Here's what else to think about today. NVIDIA's Jensen Huang, the CEO, of course, of that company, is in China for Chinese New Year. He's going to be with the team. We'll see if there's any moments where he pops up in, dim sum shops or Jiaozi hole-in-the-wall places to celebrate with his colleagues. EU-China, EU-India, in fact. That summit, of course, continues in Delhi. We've been crossing that for you, marking that for you. And aftermarket on the earnings front, it is LVMH, of course, the big one on the luxury front. It's a big week for luxury earnings. Logitech earnings as well on the tech front. And later, Boeing earnings before the market, and aftermarket Texas Instrument earnings as well in the semiconductor space. Anna.
So that's the day ahead. Not a huge amount of, very little in terms of data. So what are we going to be watching for? Closely watching developments stateside, where there were worries about the possibility of a government shutdown, of course. Skylar Montgomery-Koning is with us. Weigh in then, Skylar, on shutdown risk, because this time yesterday, the Democrats were asking to carve out part of the bill they were going to sign by Friday, and the Republicans were saying, no, we're still there, aren't we? But some of the tone from the Trump administration about domestic policy seems to have softened a little bit.
Yeah, and I think it's quite interesting that the market reaction has been very muted. And I think it actually will be quite boring even if we do get a shutdown, because that's actually what we saw last time, right? So the risk with this is that it is a partial shutdown. And yes, you get an initial reaction, but because you'll have the BLS closed, you're not going to get inflation data. So we're kind of going back to this lost few months where you don't have any data, and so yields trade in a range, the dollar trades in a range because you don't know what the Fed's going to do on the back of it. Maybe it's potentially more dangerous now because we are closer to neutral.
Because the dollar's not been in a range.
Well, yes, because we've broken out a little bit more. But, generally markets digest shutdowns quite well, actually.
Big auction in Japan tomorrow.
Yes. Yeah.
I think the Japanese risk, I mean, I think the issue is the risk isn't going away, right? Particularly for the yen, you either need a fundamental shift, which we haven't gotten. So you either need an idea of where terminal rate is in Japan, maybe 125 or something that changes that calculus around what makes the yield attractive, or you need something to shift from the U.S. side in terms of a more aggressive easing cycle.
What's a bad auction?
I think it's if it's not covered well.
Okay.
Is the main thing that you're looking at. So if people aren't buying that auction, despite the fact that yields are quite elevated, and we've had this kind of pushback in terms of not wanting yields to go that high in Japan or not wanting volatility, which is what we saw at the end of last week, with particularly the U.S. involvement being the key factor there, is in that really changes the calculus.
I don't know if this is too much of a stretch, but if we have a badly received auction, the 40-year, does that give more upside for precious metals?
Yeah, I mean, I would believe that entirely in terms of we have all of these geopolitical risks. We have risks when it comes to markets from fiscal. And what that's shown up is an everything bid for precious metals because you don't know how to hedge it. You also know that we're in an environment where you have strong growth. Monetary and fiscal policy is easing, so you don't want to be out of risk assets entirely. So what you do is you hedge instead. And you know, because we have all these risks coming up over and over again, it's created this froth in the market.
The question, there's this great. I come back to the John Author speech this morning. The S&P in gold has gone nowhere since the GFC. Now, this is the debasement trade kind of writ large, and can gold go much higher? Like it's testing the extremes at the moment. Every other asset class is paling into insignificance once you start pricing everything in gold. How much further can this go? And is silver's choppiness yesterday an indication of what's to come?
I mean, yes, we're going to continue to get choppiness. That's what you get, especially because you get encouragement of speculative flows. And so as soon as you get speculative flows, you have to be a little bit more choppy. But I think you certainly can go higher because gold's been in these really big cycles triggered by central bank buying and selling. And so if you look back to like the 70s and 80s, there were loads of central bank buying. That meant you got this kind of parabolic move higher that was massive, and then in the 90s you sold again. And so we're back to that structural bid, and central banks like China are building back to your average level that developed markets have from a historic perspective, but EMs don't. And so they need to get there, and that's why you get that continued bid regardless of the price.
Scarlett, thank you very much indeed. Bloomberg's Scarlett Montgomery-Coney. There was some really interesting reporting over the weekend as well about economists in Germany putting pressure on the government to move their gold reserves from the New York Fed, back to Germany.
All the ways that this pressure is on the US is building. It's getting into football. We haven't got time to do justice to that story, but I saw that was well read on the Bloomberg Journal.
The campaign to boycott.
Yes, talk of
boycott the World Cup,
suggesting boycotting the World Cup. But we'll
Sepp Blatter.
See if that gains any momentum.
Of all people.
Meanwhile, gold and silver still higher. Silver up by 7.5%, as we've been discussing. On the GMM screen, does not even appear in green. That's how run-of-the-mill that particular move is right now. It's in grey.
We're going to give you a heads up in terms of who else we're going to be speaking to as well in the next few hours. Martin Kocher, the Austrian central bank governor. That's at 10:10 a.m. UK time. That is it for the opening trade. The Pulse is up next. This is Bloomberg.